Hey everyone, it's Michael Valtos from Orderflows, and today I'm going to do a quick video on volume imbalance thresholds in order flow and talk a little bit about imbalances in general. Now, there's several building blocks in order flow, and imbalances are one of them. I would consider imbalances, point of control, delta, sort of be the foundation of order flow. And what imbalances are, they show you when aggressive buyers or aggressive sellers are really being dominant in the market. Now, we often, in the old days when you're trading through a broker, you'd call your broker up and say, hey, why is the market rallying? Oh, they'll say more buyers than sellers, which is basically a way of saying, I don't know, because, there's never more buyers than sellers. It's a zero-sum game in the sense that for every buyer, there's a seller. But what you can have is periods where there's more aggressive buying than selling. And imbalances really highlight that to a trader. So before we begin, a brief disclaimer: this presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Now, I'm not saying, just because you have an imbalance of a certain percent or a certain volume, you go out and you buy the market. No, you got to take everything in context. It's one piece of the trading puzzle. Put it together with the other pieces, and then you start to see the broader picture, and the market will make a lot more sense to you as a trader. So the tools I use in this presentation are the Orderflows Trader software that's available on my website, orderflows.com. So a question came up recently from one of my users, and the question was about imbalance volume thresholds, and why I have it set at 50 versus 1 or 10 or 15. Why I use 50? Well, if you go into the settings, right, there's two things as far as imbalance that you really want to, I'll say, play around with, but find your sweet spot. Find the level that you're comfortable. Imbalance trigger in percent is 400, which is 400%. So what that means is the ratio between the bid and the offer diagonally has got to be 4 to 1. For an imbalance to print, it has to be 4 times. For a buying imbalance to print, there has to be 4 times as many volume traded on the offer as traded on the bid. And imbalance volume threshold is the minimum volume that needs to trade for the imbalance to show. So if the volume traded on the bid is 4 and the imbalance and the volume traded on the offer is 15, technically that's an imbalance by over 400%, 4 to 1. Or sorry, it'd be 4 against, they'll call it 20. It'd have to be 16. But, we'll call it 4 against 20. Okay, that would be an imbalance of over 4 to 1. And the imbalance is showing because, now if you set the imbalance threshold at 50, it's not going to show up on your chart. It's not going to, the volume will show up on your chart, but it won't print as an imbalance. It'll just print as a normal trade because it didn't meet the minimum imbalance volume threshold of 50. Now, if you set it at, say, 2, it will show up, or 10, it will show up. So why is that important? Well, in markets that trade lesser volume during the day, it can be important, especially depending on the type of chart you're using. If you're using a short-term chart and, you're like, say, a 1-minute chart in the Euro currencies or NASDAQ, and you have it set at 50, chances are you're not going to get any imbalances, okay, the volume, because, it's such a short-term chart, you just don't get the volume of 50 lots at each price level in that bar. So, let's just take a look at a couple of charts really quick, and I'll explain it, and you should understand it hopefully a bit better. So, for example, we'll start with this. Okay, I'll start with this. This is a S&P 1-minute chart. Okay, so this one, the imbalance volume threshold is set at 50. Now, on a market like S&Ps, it's not going to be a problem because it trades very good volume, right? So even if you each price level you're getting, generally several hundred at a price level. You can see it here, but you're getting a lot of imbalances on a minute-based chart. Now, that's why I'm not a big fan necessarily of minute-based charts, because you use minute-based charts. Well, it says it's 10 o'clock. This is the bar. 10:01. You got another bar. Now, I don't like it where it's 10:01. We got to close and start a new bar. 10:02 close. Got to start a new bar. Over this 5 minutes here, the market was just basically going from bid to offer and bid offer like that. Rotating around this price here at 36 1/4. To me, that looking at that on a minute-based chart is there's nothing of value. When you start breaking it down to, say, a range-based chart, which shows how the market moves, from price level to price level, it moves are a lot cleaner and a lot more clearer, right? You can see, how the market is moving price related rather than just time related. So, we form a new bar when the bar closes. So again, on a range-based chart, the market looks a lot cleaner and more clearer, I believe. So, if you're looking at a range-based chart or any type of chart in the S&Ps, you got very good volume, right? Every imbalance you see is above 50. So, having an imbalance volume threshold level on a market like S&Ps, 5 years bonds, doesn't really matter that much, honestly, because you just put in such good volume in the S&Ps. Now, again, I do know people that trade imbalances, and they're just looking for certain numbers in the market. They're looking for volume on imbalances above, say 2,000 here. So just this, so if you set it at 2,000, just this imbalance will show up. I'm talking about the imbalance volume threshold, this level here. If you set this level instead of 50, if you set it to 2,000, then only imbalances of 2,000 or more will show up. So like this 607 won't show up, 832 won't show up, 2,000 will show up. None of these would show up. This selling imbalance would show up. This buying imbalance would show up. And why is it, different things are important to different traders. Okay, so find your sweet spot. Something that resonates with you. I don't want to go out and say, hey, set it at 2,000 and just look for those. Well, if you're not going to believe in it, and trust it, then it's pointless to say just look for imbalances at 2,000 and buy it or sell when it comes in. But you have to also have faith and confidence in your trading abilities to understand why you have an imbalance of such a big volume and why that's important. And just really quick, another thing is this imbalance trigger in percent, 400. Okay, it's 400%. So for the imbalance to show up, right, it has to be a ratio of 4:1. So 162 against 23.95 right here in this bar. That's an imbalance of more than 4:1, 400%. 72 against 1072, 532 against 2234. This one's very close. Now, there's some people I know that like different numbers. There's some that use 300%, 3:1 ratio. They're going to get more imbalances. Some tighten it up and they use 10:1 ratio. So they're only looking for imbalances of 10:1. Okay, so, while you have a big imbalance here, 5591 against 716, if you have it set at 1,000%, 10:1, this one's not going to show up here. So you'll miss this big imbalance. So again, it depends on you and your trading style, right? What you want to look for. 4:1 seems to be, I don't say the industry standard, but a lot of people use it, and a lot of people are very comfortable with it, and I use it honestly. Now, again, the point of this video is really about this volume imbalance threshold, imbalance volume threshold of 50. Why that's important. So I talked about different markets. If you're trading different markets, some that are more liquid than others, you're going to get more imbalances or lesser imbalances. So where's my chart here? So let's take a look at a different market here, if I could find it. Okay, so this is a euro currency chart, and on this chart I have it set at 50 right here, 50. Okay, so now euro currencies tend to trade less volume. Okay, so you'll notice you're only seeing imbalances of 50 or more. However, there's imbalances here, 40 against 5. This is a selling imbalance at 40. Okay, and there's other imbalances that are not showing up in here. 2 against 27 right here, that's an imbalance. And let me just go back here. That's late in the day. So, 1 against 9, that's an imbalance. 1 against 4, that'd be an imbalance. 2 against 7's not. 3 against 37, right? 3 against 37 is not showing up as an imbalance because it's less than 50. Now, I've got another euro currency chart here. This chart here shows imbalances. This is the same chart. It's an 8 range chart. And you'll see I have this imbalance setting set at 1 here, set at 1. Okay, so it's basically going to show me every imbalance that's going to appear. So I'll just put these two charts side by side so it's a little bit easier to see. At the same levels. Okay, so as you can see, this one is showing other, smaller imbalances. 9 against 48, 6 against 32. What time is this? 10 o'clock here. So whereas on this chart you don't see them, right? You don't see the 9 against 48 here that you see here. You don't see the 6 against 32 here. You don't see the 8 against 36, 2 against 27 in this bar that you see here. And is it important? Well, yeah, it can be, depending on what you're looking at. So earlier, time was this? 9 o'clock. So just before 9 o'clock. If you're using, if you have it set at a low number to show more imbalances, here you have a stacked imbalance. You don't see it on this chart right here, right? And you see how the market popped up a bit here before reversing and selling off. So if you're using, if you're using a smaller number, you're going to just get more imbalances. So again, on some markets, it might be more telling than others. This day, you don't really have many stacked imbalances, but there are days where you're going to get a bunch of stacked imbalances because you've got maybe 2 against 27, 3 against 12, 8 against 36, and you have an imbalance in the stacked imbalance in there. It just really depends on your trading style and what you're trading, on how you want to set it at. For me, I like to set it at 50, okay, because I just find that I'm comfortable with that. I like to see some decent volume going through. Okay, so let me just see if I could find another market just really quick to show you, to highlight to you. So okay, now this is a DAX chart. Okay, and I think I have this one set at 10 or so. Let me just double check here. Why I have it set at 10 is because, well, DAX trades a lot less. DAX moves around a lot, and setting at 50, you're going to get very, very, okay, I've set at 15. If I have it set at 50, I'm going to get like no imbalances, because if you notice in the bar, it's an 8 range chart. Very few bars. Just on this one snapshot right here, you got one bar where the trades more than 50 in the bar. Okay, I mean, you do get other imbalances, 1 against 16, 2 against 17, 1 against 19. So, but as you can see, right, this is a market that's a lot thinner. You don't necessarily get a lot of imbalances. If I have it set at 1, I'm going to get a boatload of imbalances. 1 against 7, 0 against 7, 0 against 6. This would be a stacked imbalance here. Some of these bars with all these zeros, when you got a 0, it'll show up as an imbalance actually. Even though, it's 0 against 2, I believe that will show up as an imbalance if you set it at, at 1 or at 0. But so, really what I like to see, I like to see decent volume, what I consider decent volume. And in the DAX, above 10, above 15 is decent to me. So as you can see, you don't see a whole heck of a lot of stacked imbalances. I mean, you see some imbalances, but do you see any stacked? No. Why? Because I have that volume threshold set at 15, because I want to filter it out to what I consider decent volume. And this being a market that you don't have tremendous volume the way you have it in S&Ps or bonds or crude oil even, you're not seeing any stacked imbalances in here, and I'm fine with that. I don't want to see imbalances. I don't want this whole bar to show up as stacked imbalances, zeros, all zeros. To me that's, at least to me in my analysis, that's going to be worthless. There's nothing of value in there. So here you got a stacked imbalance. You got one stacked imbalance. 3 against 17, 2 against 16, 2 against 16. They all meet my requirement of more than 4-to-1 ratio, 400%, and more importantly, the volume is above 15. And you can see the market did come off a little bit before rallying and coming off again. But again, if I have it set at 1, it's going to show a crap load of imbalances and a whole lot of stacked imbalances, which is not going to be very useful to my trading. So that's why, that's how I look at it. For just really quick, just some other markets, most markets I use 50. Soybeans, I have it set at 50. If I have it set at 25, I'd probably get more imbalances. 0 against 13, 1 against 15. I'd just be getting more and more imbalances the lower number you go. But again, it's yes, these are imbalances, 0 against 31, 6 against 36, but it doesn't meet my minimum requirement as far as volume analysis. That's why I have it set at 50. If I have it set at 1 and just show every single imbalance that appears for my style of trading, to me that's useless information, right? That's just information that's going to confuse you, the trader. Let me just see if I got this other chart here. NASDAQ. Okay, NASDAQ's a tricky one in the sense that it's not a market that I am active in, but I do watch it. And it's been quite volatile recently. I think I have my imbalance set at 50 on this chart. But NASDAQ is kind of similar to the DAX, but the difference is it puts more volume, and yeah, it's set at 50. So is there any stacked imbalances? Not really. You get close here, you got a couple there, but you're seeing it's set at 50, so it's showing me just imbalances of more than 50. Not really any stacked imbalances yesterday, or Friday rather. But again, if I have it set at a smaller number, some of these would show up. I'd have a stacked imbalance here, 9 against 39. If I have this set at 25 or 15, I'd have stacked imbalance right here, because this would be an imbalance, 9 against 39. 1 against 40. Those would be imbalances. But again, I made the decision that in my analysis, to me that's not a strong enough imbalance that I'd be interested in. Otherwise, here you have a big bunch of stacked imbalances: 4 against 24, 4 against 46, 1 against 10. Here on the way up, all these zeros, this would be a big stacked imbalance area right in here. But again, it's not showing up in there because I have it set at minimum of 50. So again, that's hopefully that explains it and makes it clearer what what this setting is and why I have it set at 50. I said, for most markets, it doesn't really, 50 is, I'll say it doesn't matter. For markets that are liquid, setting it at 50 isn't going to really have that much effect, because the market's deep enough that there's enough volume being traded that, 50 is a very, very easy threshold to reach. If you're using, say, this is a 10 range S&P chart, okay? Every bar's got thousands in it practically. So setting at 50 doesn't really matter. If anything, I should, what I would consider doing is maybe moving it up to, a couple thousand or something. But again, that would be, more refining it. 50 is my general setting. that I use for most markets. Crude, for example. There's my crude chart. Crude here. So again, I just want to see imbalances above, above 50. 4 against 40, yeah, that's an imbalance, but I'm not interested in that, because it doesn't, like here, this is why you filter out imbalances, because if you just have it set at any number, 1, any low number, that's going to show every imbalance. When you see things in the market like the stacked imbalance, that you're going to be looking for support, you want to have genuine, legitimate, solid buying, right? Because an imbalance is going to be a support or resistance level over the next few bars. So you want to have decent volume being traded to be support or resistance. Like in this case, you got a stacked imbalance here, and you see how the market is still trading above it for quite some time. Now, if I used smaller numbers, if I used whatever, 10 or 1 or 5, I'd get more imbalances. I'd have a stacked imbalance. Well, not here, but I'm sure I could find an example if you give me time. I'd have stacked imbalance, stacked buying imbalance right here. 1 against 24, 2 against 23, 6 against 40, which normally I would like off of a low. But it's not going to hold. Why? Because this volume is quite thin, even though these are technically imbalances. So hopefully by now you should understand, the importance of that and how to use it. I said, 50 is my general number that I use on pretty much all markets. Now, there are some charts that I use smaller numbers, or if you want, you could use larger numbers. There was a time where I was trading a grain contract, and I had it set at 250 because, I wanted only major imbalances. Okay. And again, there's times where some markets I have charts for imbalances of over 10 to 1. Okay. So again, it depends on your trading style. Some people love imbalances. Some people, not really sold on it. Again, it depends on you. I think imbalances are very important and a major part of order flow. So, hopefully this should answer your questions about imbalance and that setting, why you should use certain numbers. And thanks for watching this video. To learn more about my order flows chart, visit my website, orderflows.com. And thanks, and subscribe to my YouTube channel. When I get new videos, you'll be alerted to them. Bye-bye.